Hello, I'm Dr. Sonal Babbar, an associate professor in the Department of Commerce, Maitreyi College, University of Delhi. Through the coming videos, we are going to learn the chapter Income from House Property. Section 14 of the Income Tax Act 1961 provides the 5 heads of income, and income from house property is one of the heads. So we begin this chapter with the help of an example. Let us say Mr. Deepak owns a house property in Delhi and he lets it out. That means he has put a board of to let on such house property. To let is to rent out something, and he generates rental income. This rental income is income from house property. Another example, Mr. Deepak owns a house property in Delhi and he transfers such house property. That means he sells out the property. Here we would be entering the capital gains head. So when we begin this chapter, we must understand that here under the head income from house property, we are going to deal with the income which is rental receipt. And we are going to deal with such kind of examples. This will be dealt in another chapter which is capital gains. Sections 22 to 27 of the Income Tax Act 1961 cover the chapter IFHP, the short form of income from house property. Section 22 gives the basis of charge. That gives the basis of calculating income from house property. It suggests that annual value of the property is the basis of charge. Annual value, the amount for which the property might reasonably be expected to let from year to year. This chapter suggests, or this section 22 suggests, that every property has the inherent capacity to earn income. It has some natural ability or some inbuilt capacity to earn income. So even in this, we have certain essential conditions to charge income under the head income from house property. First, the property should consist of buildings or lands pertinent thereto. Second, the assessee should be the owner of the house property. And third, the property should not be used by the owner for the purpose of any business or profession carried on by him, the profits of which are chargeable to income tax. So starting to explain the conditions in detail. The meaning of property as per section 22. While we let out only buildings, then we are dealing with IFHP. If we have buildings plus lands attached to the buildings, that is lands pertinent to the building, attached to and forming part of the building, such as approach roads, such as kitchen gardens, lawns, playgrounds. So a building which is attached to land or land which is attached to building will still be constitute income from house property. However, if only land or a vacant plot of land is put on rent, then we are not under the head house property, but we may be under the head profits and gains from business or profession or income from other sources. Since the meaning of property as given by section 22 is the property should consist of buildings or lands pertinent thereto. By land pertinent thereto, that means land attached to or forming part of the building. By that we mean the approach roads connecting different departments. For example, the playgrounds for the employees, the parking areas, the kitchen gardens in the house, the stable or the kettle shed. Then we say the second condition, assessee must be the owner of the house property. And we cover the legal owner, that is, the owner who has got the property in his or her name. For example, Mr. Karan owns a house property and lets it out to Miss Zoya. So here, Mr. Karan is the legal owner of the property. Miss Zoya is a tenant. Further, Miss Zoya sublets the property to Miss Kiran. Now, Miss Zoya is giving some amount of rent to Mr. Karan. So this is rental income coming to Mr. Karan. And here, Miss Kiran is giving some amount of rent to Miss Zoya. So again, rental income coming here. Now the question arises, the rental income here, which is earned by Mr. Karan, is IFHP, and the rental income earned, which is coming to Miss Zoya, is it IFHP too? The answer is, this is IFHP, that means income from house property. Why? Because this rental income is being earned by the legal owner of the property, and this rental income could be profits and gains from business to profession or income from other sources, as the case may be, because here the rental income is generated not by the owner of the property but by the tenant of the property. Also, according to section 27, we cover the deemed owner in the meaning owner of the house property. Section 27, subclause 1 says, where a house property is transferred by an individual to its spouse or minor child without adequate consideration, the transferor will be deemed as the owner of the house property. So what are we saying? Let's look at the examples. Preeti owns a house property and she transfers the property to her husband Rohit for rupees 1 lakh, which is without adequate consideration. House property is let out and rental income is generated, which is received by Rohit. Now, as per section 27 subclause 1, for purpose of charging tax on rental income, Preeti will be considered as the owner of the house property. Another example, where Gunjan owns a flat in her name, the worth of the house property is rupees 20 lakh in the market. She transfers that house property to her son, who is a minor, and that has been done without any adequate consideration. In this situation, Gunjan herself will be deemed as the owner of the house property. Let us look at the cases where section 27 subclause 1 is not applicable. Under the circumstances where husband and wife decide to live apart, that means they are getting separated, and in that process, the house property is transferred by an individual to its spouse. In such a situation, section 27 subclause 1 is not applicable. Also, if the individual transfers the house property to its minor daughter who is married, section 27 subclause 1 is not applicable. If the house property is transferred for adequate consideration, that is reasonable amount of money, and that has been transferred to spouse or minor child, then the transferor is not the deemed owner in such a case. Where individual gives cash to its spouse or minor child and the recipient purchases a house property out of such money, section 27 subclause 1 is not attracted there also. Looking at certain examples, Sahil gives rupees 22 lakh to his wife Nikita. Out of such cash gifted to her, she purchases a flat. So here the asset which was gifted to her was cash, and through that she has purchased a house property. So here Nikita will be considered or will be the owner of the house property. In such a case, section 27 is not applicable. So Sahil, the transferor of the cash, is not considered or not deemed to be the owner of the house property. In another example, where Harshal transfers his flat to his wife Shweta and there is an agreement between them to live apart, again section 27 subclause 1 will not be attracted, and income whatsoever from such house property shall be taxable in the hands of Shweta. Section 27 subclause 2. It says, holder of an impartible estate would be the deemed owner of all the properties comprised in that estate. Impartible estate, this estate which is legally not divisible. So in such a case, the holder of the impartible estate will be the deemed owner. For example, an HUF at the time of its partition is dividing all its properties amongst its members. Now there is a building which is occupied by a temple, and that is impartible building or impartible estate, that is, which is not legally divisible. So, as per convention, the eldest son of the family becomes the holder of such impartible estate, and he is holding such property as a trustee on behalf of other members. All other members have the right to enjoy that property. Now, according to law, he will be the deemed owner of such impartible estate. So, in this example, the eldest son, being the holder of impartible estate, is the deemed owner for such property. Section 27, subclause 3, it says, a member of a cooperative society, company or association of persons to whom a property or a part thereof is allotted or leased under a house building scheme of the society, company or association is deemed to be the owner of such property. So, there is a housing scheme and let us say a flat allotted to one of the members, and such member will be the deemed owner of such property, of such flat, according to section 27, subclause 3. Section 27, subclause 3A. A person who has acquired a property under a power of attorney transaction by satisfying the conditions of section 53A of the Transfer of Property Act is the deemed owner of the property, although he may not be the registered owner. So it suggests that a person, if is acquiring a property under a power of attorney transaction, will be the deemed owner. He may not be the registered owner of the property. The conditions of section 53A suggest that there must be a written agreement between buyer and seller. So the agreement must be in writing. The buyer has paid the consideration or is ready to pay the consideration. And third, the most important condition is the buyer has already taken the possession of the property. In such a situation, the buyer becomes the deemed owner of the property transferred or acquired under power of attorney transaction. Section 27, subclause 3B, a person who acquires any right in a building by way of lease and for a period not less than 12 years. So the lease is at least for a period 12 years. So in this case, the lessee will be the deemed owner. Next, we come to the third condition, which suggests the use of the house property. The house property can be used as a let-out property or a self-occupied property, or it may remain vacant throughout the year. So, if the property is a let-out property, it can be rented out for residential purposes or commercial purposes. So, it can be let out as a residence for someone, or it may be let out and to be used as an office by someone, as a lecture hall, as a music hall, as a dance hall, or a factory, or a godown, warehouse, theatre, etc. And when it comes to the self-occupied property, there stands a restriction. Only the properties occupied for self-residence by the assessee by the owner of the property fall under this head. The house property, if used by the owner for his own business or profession, and the profits of such business or profession are chargeable to income tax, there the annual value of such property is not chargeable to tax under the head income from house property. So let us look at the use of a house property through this chart. So the property can be let out, the property can be self-occupied, or property is left out vacant. When it is let out, it could be done for residential purposes or commercial purposes. And when it is self-occupied, again, it could be done for residential purposes or commercial purposes. So when it is let out for residential purposes, we are under the head IFHP. So rental income generated is income from house property. When it is let out for business purposes or commercial purposes, it is again IFHP. When it is self-occupied for residential purposes, it is IFHP again. And when it is self-occupied by the assessee himself or herself for own business or profession, then it is not IFHP. The annual value is not chargeable under the section 22. So it is not IFHP. And when the property is left vacant, it is considered to be let out. Since we said in the beginning that this annual value concept is based on the inherent capacity of the property to earn income. So the property has this inbuilt capacity to earn income, and that is why it is deemed to be let out, considered to be let out, although it is not actually let out. Dr. Seema is a dentist. She owns a flat in Delhi and she's running a dental clinic in that flat. So Dr. Seema is using her own property to carry on her own profession. As the property here is used for the purpose of carrying on own business or profession, the annual value of the property is not taxable under section 22. It has to be dealt in under the head PGBP, but at least it is not taxable under the head IFHP. Another example where Mr. Amit owns a house property and he uses this property as his office, or he has a factory laid out in that property, or thus that property is being used as a godown by him, or maybe a warehouse, or maybe he's running a coaching center there, or maybe he's running music classes over there. So he is effectively using that property for his own business or profession. So as a result, nothing is taxable under section 22. Another example, Gen Z Limited is a manufacturing company. Let us say it is manufacturing garments, and it has a factory established in Haryana. Within the factory premises, it has built a residential colony consisting of 50 staff quarters for its workers, and Gen Z Limited lets out these quarters to the staff workers, workers at a nominal rate of rupees 200 per month. Now, this 200 per month is coming from these 50 staff quarters. This rental receipt is, the question arises, is it IFHP? So that's a question before us. So rental income of rupees 200 per month generated from letting out of 50 staff quarters is IFHP? Answers to the following questions may help you decide whether it is IFHP or not. So let us answer these questions. Is letting out of the residential quarters main business of the assessee? No, the main business is manufacturing garments. Is renting the quarters only incidental to the main business? Yes, it is only incidental and subservient to the main business. Is letting done to conduct the business more smoothly and proficiently? Yes. So the letting was done so that the workers are within the factory premises and it is easier for them, comfortable for them, and in turn the productivity of the workers will increase. Then the income from such property is, or the rental receipt which is coming, is not income from house property, but it is profits and gains from business or profession. So this rental receipt will be taken as business receipt and not IFHP. This was decided in CIT versus Delhi Cloth and General Mills Limited. Another concept which we come across under the head IFHB is that of composite rent. So whenever a tenant pays rent to the landlord, it is not every time the rent pertaining to the building. It might be the rent which is pertaining to some ancillary services, such as the services or the provision of security guard, the provision of lift, provision of swimming pool, air conditioner, electricity, fixtures, fittings, furnitures. So the rent which the landlord is receiving is a composite rent, because it includes the rent pertaining to building and rent pertaining to ancillary other services. So how to treat such rent, such composite rent? So we see whether the letting is separable or inseparable. Separable or inseparable is considered from the viewpoint of the tenant. So if the owner of a house property gets a composite rent for the property and for services given to the tenants, and if letting of the property is separable from letting of other assets, then composite rent will be divided into two parts. The amount which is attributable to the use of property is to be assessed in the form of annual value under section 22. So if we have composite rent, rent of the building will be IFHB and rent of other services will be either PGBP or IFOS, as the case may be. And this depends and this works only if the letting is separable. If two lettings are inseparable, if there is a letting of machinery, plant and furniture, and also letting of the building, and the two lettings form part and parcel of the same transaction, or the two lettings are inseparable, then such income is taxable either as business income or income from other sources. For example, in case of letting out of hotel rooms or theatres or auditoriums, the charges for a room in a hotel are not in particular for the room only. Indeed, a major fraction of the room tariff is for the facilities and services provided in the hotel. In such cases, the composite rent received by the owner of the property need not be split up, and nothing is taxable as income from house property. The whole would go as PGBP or IFOS, as the case may be. Since here, from the viewpoint of the tenant, the letting is inseparable. Other typical cases: house property in a foreign country. For a resident in India, the annual value of a property in a foreign country is taxable under section 22. And the tax incidence is attracted under section 22 in respect of a house property situated abroad. Its annual value will be computed as if the property is located in India. So all the computations will be done as per section 22 with a view that the property, although located outside India, but will be considered that as if it is situated in India, and all legal provisions of section 22 will be applicable on that. If the title of ownership of a house property is under dispute, then we are into disputed ownership. And in a court of law, generally the recipient or beneficiary of such rental income of the disputed property, or the person who is holding the property, is treated as owner for the purpose of section 22. So for the disputed ownership, the beneficiary, or let's say the recipient, of rental income of such disputed property, or the person who is in possession of that property will be treated as owner of the disputed property in question. Further, Section 26 gives the concept of co-ownership. So we have come across live examples where we see that there is a joint ownership of the same house. So if two or more persons own the same house, they are known as co-owners of the property. Where property consisting of building or buildings and lands pertinent thereto is owned by two or more persons, and their respective shares are definite and ascertainable, such persons shall not, in respect of such property, be assessed as an association of persons. So we are going to assess them as separate individuals and not as association of persons. And not AOP. The share of each such person in the income from the property will be computed in accordance with Section 22 to 25 and shall be included in his total income. So, for example, Mr. A and B co-own a house property and rental income rupees 1 lakh is coming from that house property. They are equal co-owners. That means the ratio is definite and pre-decided, 1:1. So they would be charged 50,000 in name of Mr. A and 50,000 in name of Mr. B. And all the benefits which are applicable under Section 22 to 25 will be given to them individually. Next, we deal with the subtopic property income that is not charged to tax. So, income from a farmhouse as per Section 2(1)(a) subclause C and Section 10 subsection 1 is not chargeable to tax. Annual value of any one palace in the occupation of an ex-ruler is not chargeable to tax. Property income of a local authority is not chargeable to tax. Property income of an approved scientific research association, not chargeable. Property income of an educational institution and hospital, again not chargeable. Property income of a registered trade union, not chargeable under Section 10, subsection 24. Income from property held for charitable purposes, not chargeable. And property income for political party, again, not chargeable to tax.